Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. ADISA is committed to providing education and thought leadership for the world of alternatives. My name is Greg Mausz. I'm your host today, and we're joined by Chad Willis, and he's the co-founder of Renaissance Growth Partners. Chad, really appreciate you being here today.
Thanks, Greg. Thanks, ADISA.
We're going to be talking oil and gas today. What are the main ways that you can invest in oil and gas?
Well, there's a variety of ways. Some of the oldest are by mineral interest. Back to the sovereignty of the earth, when deeds were created, there was the surface, and it's everything above the surface, and there's everything below the surface. And so that started with a mineral deed. And so today you can buy oil and gas minerals, or you can buy working interest into active participation of oil and gas wells, or you can acquire producing properties, kind of a income value add model.
Okay. And then I guess we've known about drilling programs. They've been really popular, but these other, I guess, more income-based programs.
Yeah, and drilling programs would fall in line with the working interest participation. So typically it's like, I always compare it to real estate. You can buy real estate or produce it. And when you drill wells, you basically take land from scratch and you do your due diligence and you go in and you propose development from scratch. And that is the drilling programs that we know today. It's overwhelming in a decent marketplace. It's a large share of the capital.
Well, that's a great comparison. So investors have made the decision to allocate to oil and gas, but what about creating diversification within oil and gas investing?
I think it's helpful. Natural gas has kind of an opposite cyclical pattern to oil. Oil, a lot of times, often has a different cyclical path to natural gas. And then royalties is incredibly long-term because you're basically having no cost. You're being carried along by all the oil companies, and you basically have an income there that can be existing or not. And as companies go out and develop on properties, you're being carried along for no cost to the operating cost. You're also not being billed for any of the development cost. And so as fields revitalize themselves over time with technology, you could kind of have a dormant field that gets woken up, and all of a sudden your royalties are worth more than they were before. And then with active participation, capitalizing on both oil and natural gas, they offer great diversification because of the geopolitics and because of the economics associated with them. I think they're a good value add.
So one of the things that I like how the industry's evolved is now there's kind of an oil and gas program for everybody, whether you're more income based, whether you want to do more development, whether you're more tax focused, how much risk you want to take on. So I really like all the different options that are out there. How do these different options, though, perform in different market cycles?
Great question. I think royalties, I'll start with that. Minerals and royalties are a passive instrument. The sponsors don't have much control over what happens. They don't decide when to drill a well. They don't decide to shut a well in or any of that stuff. They kind of wait at the mercy of the operators. But again, like I mentioned earlier, they're carried into all the development for no cost. So there's a potential legacy value there. With you buying producing properties and improving them, you have an ability to go in from day one and hedge your commodity price on both natural gas and oil. So I think they play a role in that. And in terms of drilling, it's all about the well cost and about the economics to achieve at certain price points. So they all offer something different, both pro and con, but that's what's unique about it.
And that's where it's great for the advisor to really custom select the program for the investor's objectives.
Tax benefits being another one. Drilling and acquiring producing properties has a different tax benefit than buying minerals, which also goes to the advisor.
You've been in the oil and gas business for a couple decades. You've seen a lot of things. You've been through multiple cycles. What are some of the misconceptions that you've seen people have about oil and gas investing?
From the average person, I think it's the Beverly Hillbilly story that you either strike it rich or you drill a dry hole. I think that's the number one thing that I'd see as a misconception. And even when you're successful in oil, I think people think if you have a successful oil and gas investment, it just changes your life. It's really just a tool like real estate or the stock market or bonds or commodities as a whole. It just is, when done right, it can offer you a great value.
And really, the science today is so much better when it comes to oil and gas drilling, right, and exploration. Can you touch on that for a minute?
Yeah, over the years, it's gotten better and better with all the different technologies used to interpret what is below the Earth's surface. as well as with more activity, you have what we like to say closeology instead of geology. You have more data to capture over time versus going out the middle of nowhere and starting from scratch. There's a lot of data that's even revitalized from seismic data interpreted in the 60s to seismic data now, 3D seismic, and you have all types of different logging, imaging tools. It's just gotten incredibly more precise. With that being said, it's not precise in exact quantities. It's just the ranges of what to expect have gotten much better with technology. It's just like most of other sectors in the world have gotten better and more efficient.
So I want to unpack more the non-drilling oil and gas programs. Can you talk more about that and how they fit into portfolios?
Yeah, I think they complement most portfolios very well, especially for ADISA and for the average investor. I think that when you go in as a sponsor for acquiring producing properties, one of the advantages you have is looking at the current environment of the seller. So you can go in and look at the electricity contracts. You can go in and look at their lifting costs. You can see where they're spending money and maybe decide that you could be more efficient with that from day one. You can look at hedging strategies from day one. There's just a lot of data to make an informed decision before you ever even write a check based on the current environment you're finding yourself investing into. Versus drilling, it's big timing of how much the well cost, if it's a hot market or a low market, as well as what to expect in terms of the range to expect there. You don't have as much information up front. It's more geological and engineering versus financial engineering. I think there's a big financial engineering value in buying producing properties.
And it sounds to me like you're de-risking a little bit your oil and gas investment by doing an income program versus a drilling program.
Time value money, you would think, would be in your favor because you're buying producing properties, ideally producing commercial quantities of oil, which ideally is paying in commercial quantities to your bank account. So you would think there's a time value money instead of waiting 9, 10, 12, 15 months to develop an oil and gas well just to figure out what you have. It could be bad news, could be great news. You also have ideally a floor of starting production to look at. So even if a sponsor is going to, suggest they can increase production, that's speculative. Maybe they can do that, maybe they can't. But at least you kind of know starting from day one what the floor of income is expected to be. Versus in drilling, when there's no production to start with, you kind of are at the mercy of just pure development.
So oil and gas is known for tax advantages as well. There's IDCs, the intangible drilling costs, but are there other tax benefits from investing in oil and gas?
There are numerous. It's one of the most tax advantageous investments, at least that I know of. IDCs are basically to incentivize domestic production of oil. Decades ago, IDCs were created to motivate and incentivize production domestically. And so all the intangibles associated with developing an oil and gas well are a write-off. So these are things that you can't physically touch, like a pumping unit or a separator. These are the drilling cost, the fracking cost, the completion cost, the advisors, things like that. These things are written off up front. But then you also have the equipment, depending on what tax year you're looking at. Section 168 of the tax code works like Section 179 for those real estate investors that are familiar with that, or industrial investors. You basically have Section 168 that allows you to excel depreciate the equipment or depreciate over 7 years the equipment. And then on the income side, you have this thing called percentage depletion allowance, which is about 15% of the gross income you can offset of your cash flow. So most people think that's just a standard 15%, but it's gross. And there's lifting cost as a difference of gross and net. So in some environments, it can work out to 25%, 30% ongoing deduction.
And that's not capped, right?
That's not capped. Percentage depletion is not capped.
So with all the different options that are out there, what should advisors and investors be considering when making an oil and gas investment?
I think the sponsor is obviously like, bet on the jockey, not the horse. I think, unless you're an engineer or geologist, you probably need to rely on your advisor, and then also the advisor is relying on, and the broker-dealer is relying on the sponsor. So I think the pedigree of the sponsor is key. I think it's paramount. I think that you need to look at their history in the fields. You need to look at their history of returns. I think you need to look at their staff and their financial wherewithal. I think it's it's number one. I can't emphasize that enough as the sponsor. Second is in the proven markets. Are they in proven markets with a lot of upside? Are they exploring for oil and gas, trying to prove up the next big find? I think that's another one. But I would emphasize again, the sponsor is probably going to be the the biggest risk.
And I echo that. I mean, all these geological formations are different. So the sponsor having specific experience in that geography and knowing all the nuances of it, I think, are critical.
They're paramount to an oil and gas investment.
Well, Chad, thank you for walking us through this wide world of oil and gas investing and all the different options that are out there.
Thanks for having me.
And thank you for watching another episode of Focus on Alternatives. Again, for more educational content, please visit adisa.org, and we'll see you on the next episode.